right, welcome to Chapter 2. And Chapter 2 is all about when you have to file and kind of the some workings of the IRS and filing standards. All right, as you are aware, we have a tax return due date, right? And there are different due dates depending on what type of entity you are, okay? So individuals, the 15th day of the fourth month following the end of the tax year. Now, typically, what does that mean? Typically, that's April 15th, all right? Now, if April 15th happens to fall on a holiday or a Sunday, then it gets moved a day or two, okay? C corporations, generally the 15th day of the fourth month following the end of the tax year. Now, for C corporations, this is very important, all right? And the reason that this is very important is because C corporations can have a fiscal year, right? So their year end isn't necessarily December 31st, which means the fourth month is not necessarily April, all right? So you have to look at when their year end is for that corporation, because they're not required to have a calendar year end, and then look at the fourth month after that, okay? And then partnerships and S corporations. All right, partnerships and S corporations, or we should say entities that are taxed like partnerships. Okay, so this includes LLCs, all right? Their returns are due the 15th day of the third month, all right? And so why is that? Well, these are called flow-through entities. And so flow-through entities actually file an information return and schedule K1s, and we'll talk more about this in Chapter 15, okay? Those K1s feed into individual tax returns of the owners. So so the individuals that own the partnership or S corp, they report the income, their share of the income from that partnership or S corporation or LLC on their individual tax return. So they need those K1s from that partnership or S corp or LLC in order to file their taxes. So that is why there is that month in between, right? It makes sense, okay? Now, let's talk about statutes of limitations. All right, because everybody thinks that you gotta keep your tax return information for 7 years, or the rest of your life, or until the end of time. Okay. Well, that is not accurate. All right. Okay. So, what is your statute of limitations? Well, that's a legal limit, right? So, for tax returns, it's the time in which a taxpayer can file an amended return, or how long the IRS can come looking for you if they think you've made a mistake or done something fraudulent. Okay? So, generally, all right, assuming no fraud. It's just your regular garden variety tax return, and you had an addition error, okay? Generally, all right, it's 3 years from the later of when the tax return was actually filed or the tax return's original due date. Okay, so what does that mean? Well, what that means is, all right, say all right, so let's talk about an example. Say my 2020 tax return will be due April 15th, 2021. All right, so let's say I'm Johnny on the spot and I complete and file my 2020 tax return on February 2nd. All right, so I get all of my information together. I sit at my bar. I do my tax return. I e-file it on February 2nd. My husband is super happy because he hates it when I wait to the last minute to do our taxes. All right, so I get our tax return filed on February 2nd, 2021. Now, when does the statute of limitations end on that tax return? Okay, it doesn't end 3 years from February 2nd. It ends on April 15th, 2024. Okay? 3 years from the later of when it was filed or its original due date. Okay? All right. And so we're back on our statute of limitations slide. And the reason I'm going back is because we did not talk about statute of limitations for other situations. So let's say that the IRS is asserting fraud. All right. So if they suspect fraud, what is the statute of limitations? Well, if they suspect fraud, the statute of limitations does not expire. All right. So the statute of limitations in fraud is indefinite. All right. What about failure to file? All right. Our example that we were just talking about, you're a single filer, you make $50,000 a year, you should have filed your tax return, but you decide you're not going to. Failure to file, the statute again is indefinite. Okay. Now, there's an additional statute that is kind of in between this 3 years and indefinite, right? And that is if you understate income by 25% or more, all right? If you understate income by 25% or more, your statute of limitations is 6 years, okay? So that is it for Chapter 2. Hope y'all are having a good week. Bye. All right, so let's look at another example. So we've got Bill and Mercedes. They filed their 2016 tax return on September 6th, 2017. So they're a little bit late, right? Because they should have filed it in April. But it's okay because they received an automatic extension. And that is a thing, right? You can receive one automatic extension, 6-month automatic extension. And so they had an automatic extension until October 15th. When does their statute of limitations end for this 2016 return? All right, I'm pausing here for effect to let you think about it for a minute. All right, so they filed it September 6, 2017, but it was actually due originally April 15th, 2017. So remember that the statute of limitations ends 3 years after the later of the actual filing date and the original due date. All right? So statute ends September 6, 2020. Okay? Because that's the later of those two dates. So I am going back very quickly. All right. All right. So obviously, IRS audits are a huge topic of conversation. By all accounts, IRS audits are an unfortunate situation for taxpayers for sure. They're not a lot of fun. And so, in general, right, they select returns for audit because there's something that makes them believe there's a high probability of an error on that return, okay? And so, the IRS has gotten high tech just like the rest of us, and there are 3 different ways that they use computer programs to try to see who might have an understated tax liability. So either you made a mistake or you were overly aggressive. Okay? All right, so the first one is this discriminant function system. Okay? So this discriminant function system is really pretty cool because it's an algorithm, right? And so what they do is they look at your level of income and they compare it to taxpayers across the country that have a similar level of income. So say you're married with 2 children and you make $50,000 a year. They're going to compare your tax return to other married individuals that also have 2 children that make $50,000 a year. And they're going to look at your deductions, medical expenses, your mortgage interest deduction, those types of things, and decide if you are, on average, similar to those other taxpayers that are in a similar tax situation as you, okay? And if you're outside that norm, then you have a higher probability of being audited, okay? Document perfection. What this is looking for is math errors. Did you add things properly? Do you have a decimal in the wrong place? Okay. Information matching. This one's pretty slick as well. So I'm an employee of UMSL. UMSL submits employment tax information to the federal government. All right. So if I decide, you know what, I do not like paying taxes that much, I'm not going to report my UMSL income to the IRS. So I won't include that W-2 in my tax return. And then the IRS won't know that I even made that income, right? Well, wrong, because of this information matching system. This information matching system allows the IRS to look at UMSL's records, and I'm listed as an employee on UMSL's payroll tax records, and then the IRS knows to go looking for the UMSL W-2 in my tax return, okay? And if I were to leave that out, then they would send me a nice little note that says, hey, we noticed you didn't include the W-2 information for UMSL, okay? So that is the document matching program. It's pretty slick, really. Statutes. All right, 3 general types of audit, and they're listed here in order of the level of severity, the level of complication, and, thereby the level of pain as well, okay? So a correspondence examination is the most common, all right? Typically, it's conducted by mail. All right? And you get a letter, all right? You get a letter that says, hey, we noticed that you didn't include your UMSL W-2 on your tax return, and we are going to need you to submit X additional dollars of tax as a result of that income not being listed on your tax return, okay? They send you a letter. Now, especially from a state perspective as well as a federal perspective, you can do a lot of sharing of documents electronically. But you get a letter in the mail. You respond to the letter either with your verification for what you did, or you send them the documents they request, okay? An office examination is exactly what it sounds like. You go to a local IRS office. These tend to be broader in scope than your correspondence examination. Here, let me write a couple of things. You should plan on taking documents with you. Because this is where the IRS says, show me, all right? You say that you are self-employed and you had all of these expenses related to your automobile that you say are deductible. I want to see your records. Show me your Excel sheets. Show me your receipts. Okay, so that's where you pack up your grocery bag full of receipts and take them to the IRS office. All right, the field examination is really the most painful of the 3, all right? And that is where the IRS has so many issues to look at, or they want to look at a multiple number of years. They come to you, all right? They decide, you know what, there is no way that we want this person to bring that many grocery bags of receipts to our office, so we are coming to their place of business. All right. And these field examinations are typically reserved for businesses. All right. And the IRS comes to you. Now, truth be known, lots of large Fortune 500 companies have what's called a continuous audit program going on. AT&T, for example, is a great example because I spoke to their tax director a couple of years ago, and they essentially have an IRS person that has a desk in their corporate office, and they're in continual communication with the IRS to make sure they're properly classifying transactions and kind of doing a back and forth negotiation about what will this type of transaction cost me. So a field examination is as painful as it sounds if you're not, hosting the IRS at your place of business permanently. All right, so those are the types of audits. You should absolutely know a little bit about each one of those. Of key, all right. So this is a graphic from your textbook, and it's a pretty good graphic because it explains the appeals and the litigation process. And the reason I include this, even though we don't do a tremendous amount from the legal side of tax information right now, but it's important to know that there is an appeals and litigation process. Okay, so just because the IRS says you owe something, that's not the end of the story. You can appeal their decision, especially if they have set up a payment plan that is way too aggressive for your particular situation. There is an appeals process. And if you and the IRS cannot come to an agreement, then there is a litigation process, and you can go to tax court, and there are different levels of tax court, but the takeaway from that is there are lots of gray issues in our tax code, and the IRS and taxpayers don't always agree on which side of the line your transaction goes on. And so there is a process by which you can go in front of a judge and sometimes a jury as well, and have your tax issue litigated that way. Let's go back a minute. You will not have to memorize this appeals litigation process. All right. I think it's important to know that it exists, but you will not have to memorize it. All right. You will not. All right. So since there is a litigation process, there is also a judicial system within the tax world, right? So we're going to talk very briefly about these different levels of the judicial system. All right. So U.S. tax court. U.S. tax court is exactly what it sounds like. It only deals with tax issues. Okay. It's a national level court. The judges are tax experts. All right. The cool thing about tax court is you don't have to pay the tax liability first. All right. Tax court is a great place to go if the IRS is saying you owe $15,000 and you're looking at that going, I don't have $15,000. So, and if you think the IRS has made a mistake, then you can take them to tax court and you don't have to pay that fine prior to going to court. All right. So that is unique with the tax court. There's also district court. All right. District court is exactly what it sounds like. It is a local court. You can potentially have a jury trial. Now, these judges are not tax specialists. All right. U.S. Court of Federal Claims. This is a special court for monetary claims against the U.S. government. All right. And then the U.S. Supreme Court. The U.S. Supreme Court is the same Supreme Court that we hear about, right? That the president appoints, 9 justices, right? So this is the U.S. Supreme Court. Not all tax issues can go to the Supreme Court. Obviously, not all issues can go to the Supreme Court. But the Supreme Court does hear tax issues when they are significant enough. Okay? All right, so this is just a map. You can see the districts for the courts of appeal. All right, and you'll notice that the great state of Missouri and the great state of Illinois, even though they are right next to each other, they are not in the same district. And so what that means is if you are an Illinois taxpayer and you go to tax court in Illinois, you might get a different decision than a taxpayer from Missouri who goes to court in Missouri because they're in different districts. So even though you have neighboring states, you can have districts, circuits decide differently on very similar issues. All right, where do our tax laws come from? Well, the laws themselves come from primary authorities, and there are three general sources of tax law. Statutory sources, okay? So statutory means of the law, all right? So the Internal Revenue Code, which is written by Congress, is a statutory source, all right? Judicial sources, the courts, all right? When the courts rule on a tax issue, they are essentially making tax law, all right? It's not written down in the Internal Revenue Code, but you can use those decisions as precedent for what your next taxpayer can do, all right? And then you have administrative sources. And these administrative sources, lots of times are written by the Treasury Department, okay? And lots of times they are designed to explain the Internal Revenue Code. So you have the regulations, okay? Additionally, you have all kinds of IRS pronouncements. For example, this last year in 2020, the great year of 2020, the IRS sent out a notice that extended all of the due dates for tax returns as a result of the COVID pandemic. Okay. You also then have secondary authorities. Now, it's important to know that primary authorities can be cited. So what that means is if you are doing a research project for your tax partner at your office, you can cite primary authorities. Secondary authorities should not be cited, okay? So they're unofficial authorities. I would be a secondary authority, all right? As knowledgeable as I am, you do not want to go to your tax partner in your office and say, well, Professor McFessel said, you want to find that, Professor McFessel said Internal Revenue Code Section 162, and then quote the code, not Professor McFessel. All right. This again is directly from your book. It is the tax legislation process. It's important to know that that how do tax laws begin? Well, they begin with a proposed tax bill in the House Ways and Means Committee. All right, and then there is a parallel bill that's also begun in the Senate Finance Committee. And before anything gets voted on, they have to come together and create a bill that they'll both put forward, and then it gets voted on in joint conference committee, and then it can be potentially signed by the president. Okay, so it is important to understand this legislation process because it, in some way, explains a little bit, at least, of why the process is many times so lengthy, right? A lot of people have to come together and agree on major portions of law before it can go before a vote at the presidential level. Okay. All right, that brings us to tax professionals. As tax professionals, what are your responsibilities if you choose to be a tax professional? Well, obviously there are various codes of conduct that you are expected to adhere to, just like any other accountant, right? And especially if you become a CPA, there is a level of competency, right? And a level of client care that is expected from CPAs. So just like auditors, tax professionals are required to adhere to the AICPA Code of Professional Conduct. There is additionally statements on standards for tax services that is specific to tax professionals. And then the IRS has Circular 230. Okay, now it's important to know that the AICPA and the state boards of accountancy all kind of follow and dovetail into this IRS Circular 230. So it's not really that there are, all of these separate codes of professional conduct that you have to navigate. They all dovetail together to really make one encompassing code of conduct. Okay. Now, if you fail to comply and have a fairly egregious error regarding one of these codes of professional conduct, you can end up losing your license. Okay, so sometimes the penalties can be significant. All right. Now, what happens if you fail to properly comply with tax laws? Well, whether you're the taxpayer or the tax practitioner, there are penalties that can be levied against you. All right. Civil penalties are the most common. All right. Typically monetary. And they're imposed when tax practitioners or taxpayers violate tax statutes without reasonable cause. So what does that mean? Well, if you fail to file your tax return, there can be penalties involved if you are required to file a tax return. So say you are a single filer and you make $50,000 a year and you just decide, you know what, I do not like paying taxes, and that tax form, it is confusing. I am not paying my taxes this year. The IRS can absolutely come after you for that and assess a penalty, a failure to file penalty, for not having filed your tax return in a timely fashion. All right. There are also criminal penalties. Criminal penalties are much less common, and they're typically reserved for really egregious fraud type situations. Now, in talking through these penalties, it dawned on me that when we were talking about statute of limitations, I could have also mentioned that failure to file penalties are much more stringent than failure to pay penalties. So even if you cannot pay the tax that is due or that is owed, it is absolutely important that you file. Okay. From a penalty perspective. Also, remember, you may not have to file, but you might want to file, right? Because the only way to get your withholdings as a refund is to file your taxes. All right, that is it for Chapter 2. Have a great day, and I will talk to y'all later. Bye.